Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 33 of our YouTube channel and podcast. And I could not be more excited to just continue working with you guys and talking to you about personal finance topics that I think are really going to help you and really going to help you to grow your money long term and help you to get in the right place and follow a financial plan that will do you the most long term good. Today, we are going to talk about a topic that everyone should know about, that everyone should utilize at some point in their financial action plan, and that is mutual fund and ETF investing. Because if you'll remember, we're talking about things that we can invest in. Not necessarily the accounts. We've talked about the accounts, employer-sponsored accounts, IRAs, brokerage accounts, different things like that. We've talked about that. But what we're talking about now are the things that we put in the accounts that actually increase our wealth, that actually increase the value of our money over the long term. And mutual funds and ETFs are such a big part of that. And that's what we're going to focus on today. So just keep watching. This is going to get really good. And it's going to be a lot of stuff that will really help you, especially if you have an employer-sponsored plan or an IRA or things like that, to where you can know what you're investing in and understand what these things are, these options that you're given to invest in different plans and things. Before we get started, if you could, go down below, click the subscribe button. Also, like this video, click the thumb. Leave me any comments. Leave me some feedback down there that I can get back with you guys and talk to you about different topics that I'm going over in these videos and maybe help you out a little bit just by commenting back. Maybe that would help you out a lot. Also, follow me on social media at MNO with Dylan. That'll do you a lot of good. I put a lot of stuff out there on social media that can be really helpful. And if you want to work one-on-one with me, go to my website, www.mnowithdylan.com, and you'll find more information about the financial coaching services that I offer, and we can set up a financial plan that will work best for you. And lastly, if you're listening on iTunes or Spotify or Apple Podcasts or Spotify Podcasts, I appreciate you. If you would, just go and subscribe. And if you want to go listen there, you can definitely do that. So you can go and it's just Money's No Object with Dylan Howell. And you can subscribe to the podcast version of this show there. So what is a mutual fund? Let's start with mutual funds. Well, a mutual fund is both an investment and something sold by a particular mutual fund company. So when you're buying a mutual fund, you're buying shares in this investment company, in this mutual fund company, and those shares are indicative of the assets that that company purchases. Because what these companies do is they create mutual funds of different asset classes, different objectives, different diversification strategies, all these different things that they're creating mutual funds to do. They create them, and then when you purchase shares of the mutual fund, then what you're doing is you're giving that company money to go invest via the fund manager, whatever manager of that particular mutual fund wants to invest in. And it's typically going to follow a particular strategy. And if it's indexed, then it'll just follow an index and you don't have to worry about what they're invested in. But we'll get on that just in a little while. But you're giving this company money that they are going to go and invest in particular securities. And so what you really own is a share of the mutual fund company, and they go and invest the money, and your performance tracks what they go and purchase in the percentages in which they go and purchase. So what this does is this pools the money of a lot of different investors, and it allows a fund manager to go and purchase stocks or bonds or commodities or even real estate investment trusts and all these different types of securities that the fund manager can go purchase. And then the returns from those things are split to all of the investors in the mutual fund, proportional to the amount of the fund that you put in, the amount of money that you put into the fund. And many of these funds have minimums, and what those minimums do is they make it to where the fund manager can actually use your funds to buy the things in the proportions that they need to buy it. That's why a lot of index funds have minimums, because they can go in and purchase larger portions of the index with the amount of money that you put in. And they want you to be longer term holders and to keep your assets in. And one way to kind of ensure that is make you meet some type of minimum. Then they can be a little more assured that you're serious about purchasing that particular fund. And with mutual funds, shares are not traded throughout the day like they are with stocks, or even as bonds get traded throughout the day. They're not done that way. What happens is at the end of the day, the particular mutual fund company reconciles all the shares of the mutual fund, because what it's doing throughout the day is it will track the value of the assets in the fund, and then at the end of the day they reconcile, meaning they see how much the value of all the things in the fund has changed, and then that is going to be your percentage return for that day. And so they'll show that. Typically, with a lot of mutual funds, you find out what your return was for the day at 5 o'clock of that particular day. And I don't know if you've ever heard of Lending Tree or Prosper. These are places where you can do what's called peer-to-peer lending, meaning I can lend money and somebody else gets that money and then pays me some interest rate, like I'm lending to them directly. Mutual funds are kind of just a lot like that, in the way that individuals get their money pooled together for a particular purpose, because the same thing happens when you're lending money in those P2P sites, that your money can be pooled with other people's money, and you can make a return. Same thing happens in a mutual fund, and so if that makes a little more sense to you, then that is the way you should think about it. But just with owning whatever assets the mutual fund owns, that's how you make your return. And what these mutual funds do is they give smaller investors an opportunity to be broadly diversified and to own a lot of securities that they probably couldn't afford to do if they were to buy the individual securities. But if they buy the fund, they can do it at a much lower price, and even have access to professionally managed funds at particularly low prices, based on what those funds cost versus what professional management may cost elsewhere, like in a hedge fund, or what it may cost to buy all the things that those professional managers buy by yourself. So it's just a lower cost way to do something that you wouldn't be able to do otherwise for most individuals. And you can buy mutual funds for different things. So there are stock mutual funds that can take care of the equity or stock portion of your portfolio. There are bond mutual funds that can take care of the fixed income or bond portion of your portfolio. And there are funds for just about any other objective that you can think of. Some mix stocks and bonds and create what they call balanced portfolios. And so you have some percentage in bonds and some percentage in stocks, and it tracks that portfolio as they go. So mutual funds are multifaceted in that way. And some are made for more simplicity. So like the index fund is just about as simple as you can get. It just tracks an index like the S&P 500 or the Dow Jones or the Russell 2000 or different indexes like that. It's just going to track the index directly. And some may be really complex, like they'll hold a lot of different asset classes and it's really actively managed and things like that. And so it can be really simple or really complex, and a lot of that's based on whether it is an active strategy or a passive strategy. But you have to know that the active strategies are going to cost you more, even though your cost of doing the same thing would likely be much higher anyway. It is going to be more costly than the passive strategies, and not to mention active strategies don't outdo passive strategies very often. And what I mean by active and passive is, like, passive is index fund investing, where you're just buying a preset group of companies or group of debt or whatever it may be, if you're buying stocks or bonds or whatever. But an actively managed fund is a fund manager making all the individual security choices for you in your place. And that can be kind of tough, because their returns don't always really add up to the cost that you're paying them. And what mutual funds do in order to make some money from you, because all of the returns get passed back to you as the fund investor, but how do they make money? Well, they'll make money by a couple different ways. One is the expense ratio. That's the most common. And that's just a percentage of the money that you end up investing with them, their assets under management, they take as a fee. And typically, expense ratios, especially now, are really low relative to what they have been in the past. Most index funds are anywhere from 0.1% down to zero. Some are free. So you can look at that. That's the first cost of a mutual fund. Then there are what's called 12B1 fees, and these are marketing expenses for the mutual fund. And we've talked about these when we talked about minimizing your fees. So there were 12B1 fees. Then there are also loads and commissions sometimes. So loads are you pay some percent up front or when you buy or at the back end when you sell. And so those are front end or back end loads. And those are not as common as they used to be, but they still exist. And then there are commissions that can also be made and have to be paid by the investor. But we've talked before, we want to keep our fees as low as possible, and mutual funds still allow you to do that in many, many cases. And then not to mention the overwhelming majority of employer-sponsored retirement plans, like we've talked about previously, the 401k, the 403b, the 457, they only offer mutual funds for you to invest in. The vast majority only are offering mutual funds for you to invest in. So understanding what a mutual fund is super important because that is what the vast majority of retirement savings is going into because the 401k is the most common type of investment account that there is out there in the United States. So understanding what these are is really going to help you if you do have an account like that and that's something that you're having to pick between different types of mutual funds, then you really need to pay attention here because they are so prevalent, they are so common, and they're really, really common in just building the wealth of individuals long term. So let's talk just for a second, just so you completely understand how mutual fund returns work. I'm going to read this for you. That way I don't miss anything and you can really see how these returns are passed from the mutual fund to the individual investor. So let's dive right in. So the income earned by the fund in dividends on stocks, so if they hold stocks, dividends that are paid to them from the stocks they hold, or interest on bonds, so the coupon payments that the bonds pay, held in the fund's portfolio, that's how the income is earned. And a fund pays out nearly all of the income it receives to the investors in the fund. And that's done in the form of what they call distributions. Then the funds often give investors a choice either to receive a check for the distributions or to reinvest the distributions into the funds. I suggest reinvesting just because that's going to do you so much more good in the long term and the compounding and the growth of your money. But that's just a quick aside. I would prefer you to reinvest. Then if the fund sells securities that have increased in price, so if they hold a particular stock and the stock has gone up and they sell it, then what happens is the fund has a capital gain. And most funds also pass on these capital gains to investors in the form of a distribution as well, which again can be reinvested in the fund if you so choose, which you typically should. And then if fund holdings increase in price, so just you don't sell it, but the fund holdings increase in price, then the mutual fund increases in what they call NAV, net asset value. And so the value of the fund's assets go up, but those things are not sold, like I just stated. Then the fund shares increase in price. So the share of the mutual fund will increase in price. And you can tell that those shares increase in price because the value of your portfolio holding the mutual fund will subsequently increase in price. And so it will provide you with an increased value of your mutual fund. So that's how you're going to receive your return as an investor in a mutual fund. And it's just important to understand that because if a distribution happens or something like that and you don't understand why, then that can be an issue. So that's where your returns come from, whether it be the sale of a share of stock that's gone up or a security that's gone up or a security that they're holding that just goes up in value or some income. Now you know where those returns actually come from. So what about ETFs? Well, first of all, what's an ETF? What does ETF stand for? ETF stands for Exchange Traded Fund. Okay, these are really, really similar to mutual funds. And in many cases, what these companies that sell mutual funds do, and these companies are like, if you've never heard of them, Vanguard, Fidelity, Charles Schwab, these different mutual fund providers. What they will have is a mutual fund and an ETF that are invested the exact same way, but one you can purchase as a mutual fund and you could purchase it in the same way as an ETF. And why would they do that? Well, let's dive in a little bit to what an ETF is. ETFs are in many ways exactly what a mutual fund are, except for the fact that ETFs can be traded throughout the day. So they're a fund and they are managed by a person or a group of people, and they're invested either in an index or actively invested or whatever. But you can trade them throughout the day like shares of stock. So that's how they distinctly differ from mutual funds, which, as you can remember, we talked about, they don't reconcile until the end of the day. So you can't buy and sell mutual fund shares throughout the day. Now, ETFs only trade in full shares. So if you go to buy an ETF, you have to pay the full price of a share in order to get a share. But with mutual funds, once you start systematically investing and you meet the minimums, you can buy all these partial shares of mutual funds. Now, just a quick aside, I know with a lot of these little apps and a lot of companies are allowing you to buy partial shares of ETFs, and I get that. But for your long-term investing purposes, you can only buy the individual shares. If you're doing it in like an IRA or something like that, you have to buy the full share, where you don't have to with the mutual fund. ETFs are also really commonly held in just one asset class. They don't mix as much and do like the balanced fund thing like the mutual funds do. That's not to say that they can't, but a lot of them don't, just for simplicity's sake. And ETFs typically have lower expense ratios in many cases than mutual funds do. They don't hold commissions. They don't have the 12B1 fees and all those types of things. So it can be less costly for certain mutual funds if you held them in their ETF form, if there is an ETF equivalent. But ETFs and mutual funds can, hold bonds and stocks, and they can be value or growth strategies. They can be domestic or international. They can do all these different things, and they can both do them. They're almost equivalent in that way. But the biggest difference are the fact that the ETF trades during the day and the mutual fund doesn't. And people see value in the ETF trading during the day. Now, the devil's in the details here, because you may say, well, I want the ETF because I want a little more flexibility. Well, if you're trying to do long-term investing, you don't necessarily need the flexibility of the ETF. You could just use a mutual fund. Now, I do understand this. If you are just beginning and you want to invest your first $500 or $600 or whatever, you're likely not going to meet a mutual fund minimum, but you could buy the shares of an ETF. And so that's where they can be really useful. If you're a really small investor and you're just beginning, buying ETFs can be really useful. I actually not long ago just helped my brother to do that exact thing, to purchase shares in an ETF that he couldn't meet the minimum when he was just beginning for the mutual fund. So that's a distinct advantage that those ETFs give you, but they tempt you far too much in the long term to buy and sell when it's not necessary. So what are the pros and cons of fund investing? So mutual funds or ETFs. So let's talk about some cons first, okay? So the first con, the massive amount of diversification, it commonly leads to returns that are good, but not quite as good as they could be. Okay, so this is a con, but this is kind of a nitpicky con. Okay, so with so much diversification, you can invest in crap, and you probably will invest in some crap throughout a highly diversified mutual fund. So if a mutual fund holds 2,000 stocks, not all those stocks are going to go up, and not all those stocks are going to be the best companies, but you're going to be really broadly diversified. That will provide you with some good returns, but you will also be drugged down a bit by those companies who don't do so well. So that's one particular con. Also, certain companies tend to dominate. For instance, Apple is over 6%, or was recently over 6% of the S&P 500. That means that if Apple stock increases by, let's say, 10%, and the rest of the S&P did absolutely nothing, then the S&P would increase by 0.6%. And that's crazy. That means that we have a lot of of the value really held in those larger firms. And so those large firms can drive returns a lot. That can be really good. It can also be really bad if they are performing negatively relative to the rest of the firms in the particular fund. Another con, and this is once again a nitpicky con. Most of the time, regardless of what you're investing in mutual fund wise, you're following the market that particular mutual fund is either tied to, or it has its benchmark. You're basically making what the market makes because you are so broadly diversified. I have no problem with that. Make what the market makes, especially the stock market over the long term. Absolutely do that. But don't get caught up in actively managed funds that are just making what the market makes, because you're going to pay a lot for not a lot. So if you're going to just make what the market makes, just buy the indexes, and those do you a lot of good. And then another con, mutual funds can lack tax efficiency. And what I mean by this is those distributions that mutual funds give. Well, if that's being held in a brokerage account or something like that, those are going to be taxable distributions. So it can lack some tax efficiency that an ETF is actually going to be able to help out with. But that's a con of a mutual fund, is a tax efficiency, and also the minimums on a mutual fund are a particular con, and that kind of goes right along with having to buy full shares of ETFs, also a downfall. But all these things are really nitpicky. This is why these things are so good for you, because it's hard to find the bad, but you just have to be aware of the little things that could drag you down in your fund investing over the long term. So what are the pros? Let's talk about the pros now. Well, I said earlier, these are some of the top wealth building tools that individuals use. So let's see why. First of all, they're simple to invest in, and they are great for the long term. And that's what we like, simple and for the long term. And so if you can simply understand that you're buying the average return of what the fund holds, then you understand more than most. And they're really easy to invest in, which makes it even better for most investors who may not understand the intricacies of certain things. So they make them really available to individuals, and that's such a great thing. And it really encourages investing by the small investor, which I really love. And they will provide, at minimum, market returns in many cases, especially if you're buying the indexes. Then you're guaranteed that you're going to make the market returns. And that's what we want to kind of index ourselves to, are the particular markets that we invest in. We want to, if we want money in stocks, we want to make at least what the market makes. If we're putting money in bonds, we want to make at least what the broad bond market makes. So both of those things are exactly what you want. And so you want to be able to keep up with the markets, and these funds allow you to do so. Then naturally, diversification, done. I mean, you can't be much more diversified. Asset allocation can be completely done by fund investing, whether it's buying balanced funds or buying actively managed balanced funds, or whether it be buying mutual funds of different asset classes. Super easy to do asset allocation within fund investing. And it also allows you to build wealth based on the firm factors. So what do I mean? You can buy mutual funds and ETFs that cover growth firms, value firms, income paying stocks, or things like that. Just they can allow you to get in these different categories and diversify through those categories quite easily. And so that's something that it's just really costly to do on your own. So pretty much point blank, good ETFs and good mutual funds will build wealth long term. They do. That's what they do. That is why most millionaires in America hold mutual funds within their 401ks, and they have built wealth via mutual funds and via this fund investing idea. And it's because it's simple. They are good tools, and you should take advantage of them with the majority of your investing. So what are my recommendations when it comes to fund investing? Just real quick, there's just a few. First off, most of what you have should be in mutual funds and ETFs when it comes to investments, just because it's going to be hard to beat. You're not going to be able to beat indexes too often. So buying the index via the mutual fund or the ETF should be the larger part of what you do. They diversify you easily. Asset allocation can get done easily. Just doesn't get much simpler than fund investing in that way. Also, they can be really good for the tax efficiency in a brokerage account if you buy an index fund that has low turnover, things like that. So they can be used well in just about every type of account you have, whether it be your 401k, 403b, 457, all those employer plans, your IRAs, or even in the brokerage accounts if they have low turnover. All of those things can really help you to maximize your wealth long term, and it can all be done through funds. Also, don't reevaluate them too often. Give your funds time to work. They are largely diversified and can have broad asset allocation. So they should follow an index or the market, and especially if you're having these certain index funds, the S&P 500, the Russell 2000, whatever, those index funds, they're tracking with the market, so you're not going to make much better than what they're doing at any given time. So don't reevaluate too often, because it can allow you to make stupid choices and stupid changes. Also, if this is another little suggestion that I have, if you don't invest in individual firms or individual bonds or individual stocks, anything like that, you don't have any interest, you don't want to do the homework, you don't have the time or the knowledge to do so, this is all you should own. All you should own should be funds, either mutual funds or ETFs, because they're going to do things for you over the long term in a prudent way that cannot be done without you being able to put in the homework on individual securities. So I don't want you to have to do that if that's not what you're interested in, if you're not good at it. And most people aren't good at it, so don't feel bad. Most people are not good at picking individual securities. They cannot beat the market generally. So buy the indexes. Do the simple things, okay? And that will do you a lot of long-term good. And then lastly, feed them systematically and ride them to long-term wealth. At the end of the day, that's what we want to do, right? We want to feed our investments systematically and grow our wealth. And you can do that with your funds. So make sure that you're feeding them, make sure that you're putting the money in, and allow those different funds and index funds and maybe even active funds, if they are that much better than the index funds, to do a lot for you. Make sure you're keeping your fees low. Make sure you're getting the returns that you should make. And you're going to find your way into long-term investing success, because the biggest indicator of building wealth is simply putting money into the accounts. And so just continue feeding them. Don't stop. When it comes down to it, funds, ETFs, mutual funds, they play a pivotal role in your wealth building journey, and they should not be taken lightly. You should learn everything you can about them, and listen to this video again. Look out for the clip that I put out this weekend about this video, because these things are going to get you home. These things are going to get you more than likely to your long-term wealth building goals. Unless you're doing a lot of real estate investing or things like that, you are going to put money in mutual funds, and you're going to put money in ETFs, and that's what's going to get you to where you want to be. So don't neglect to learn. Don't neglect to build the knowledge, because these are proven wealth building tools. And if you've seen it done and it's historically worked, then allow it to work for you. This will allow you to have exposure to all that you want: stocks, bonds, different sectors within the stock market, different types of companies within the stock market, all these things are available through ETFs and mutual funds. So don't think that you just have to pick certain companies out because you don't want to invest in a particular way. You can do it in a smart way by still using fund investing. Just don't try to get too tricky, and don't get too caught up, because sophistication when it comes to investing in funds can lead you to lagging the market, and we don't want that. We want to at least make market returns over the long term. So hey, I appreciate you guys watching this video. Again, go down below, click the subscribe button, click the big thumb, like this video, leave me any feedback in the comments. If you're on Apple or Spotify podcasts, subscribe to the podcast. If you want to go there and do that, please feel free. Go listen to the audio version of this show. If you need to listen to this show again, if there was a lot of information, this show was really pivotal. There was a lot of information that everybody needs to know. So go back and watch it again if you have to, and really get the most of it, the most out of it that you can. Also, go on social media, follow me at MNO with Dylan. A lot of good stuff there. If you want to start a dialogue and build a financial plan through some financial coaching, go to my website, www.mnowithdylan.com, and you can find out all about what I do and how I can help you there. So tune in tomorrow where I'm going to talk about tax efficient investing when it comes to tax deferred and tax free investment vehicles. And so that's going to be something you really want to look at to really take home the most money that you can. So check out that video. Also check out the clips that I put out on Saturday and Sunday, as I'm not doing the weekly rewinds anymore, but I'm putting out the individual videos clip. That way you can digest those a lot easier, and hopefully it will push you back into the videos that you're most interested in. You'll be able to watch them in more detail in those ways. So check those out. And guys, I just want to remind you that I am really grateful for you watching and listening. And I really hope that we can continue this journey forward, and I can continue to teach you guys about these different personal finance topics that are so crucial, so huge to your long-term financial success. So keep watching, and I'll keep putting it out, and we'll just continue on this road, this journey together. So, hey, thanks for watching this episode of Money's No Object. I'm your host, Dylan Howell. God bless.